Hello, everyone. Thank you for joining us. We are going to give everyone about 60 seconds to get hopped on. Make sure everybody gets a chance to get logged in. In the meantime, before we dive into our presentation, I want you to take a look at the little tax brain teaser about Sue that you have on your screen right now while everybody else is getting logged in here. Sounds like fun, right? Having a brain teaser right off the bat, give you a little quiz, see what your awareness of the tax laws are when it comes to taxes and Social Security specifically. So again, we're going to give everybody, let's give everybody about 30 more seconds and we'll get started here. But again, take a look at that tax brain teaser. Also, again, if you have questions, definitely want to make sure we get a chance to answer those. May or may not have time to get to those during our presentation today, but those do get emailed to me. So I will make sure I respond to those. So again, feel free to go ahead and start dropping any questions that you may already have about retirement planning, tax planning, Social Security, whatever it might be. Let's give it about, let's call it 15 more seconds and we'll get started. All right, well, let's go. So let's talk about our brain teaser you see on your screen before we get into our introductions and presentation. So here we have Sue. After working hard her adult life, Sue, who is 65, she is finally retired and she's going to more concerts than ever before. Let's look at Sue's financial picture. She has $48,988 in taxable income, which includes $37,500 of Social Security benefits this year. As you can also see, Sue's $48,988 of taxable income puts her in the 22% tax bracket because it's more than $47,151 and it's less than $100,525. Now, towards the end of the year, Sue decides she's going to take an extra $1,000 out of her IRA for a trip with her granddaughter to see Taylor Swift play in Austin. I don't know if Taylor Swift actually played in Austin, but you get the point. She's going to take an extra $1,000. How much is she taxed on that extra $1,000? Now, the logical answer is that for every dollar of IRA money she pulls out, she pays 22 cents in federal income taxes. Therefore, if she took out $1,000, she should owe $220 in federal income tax, 22% tax. It sounds like it'd be simple enough, right? Well, surprise, it is not 22%. As you probably were guessing, it's going to be something different than that. She actually owes $407 in tax, a 40.7% federal tax rate on that extra income. Thanks to the madness that it is our tax code and the unique formula that determines how our Social Security benefits are taxed, the real answer is that Sue owes $407 in taxes on that extra $1,000 in income. And I'm actually going to share you where this comes from, how this math actually gets determined a little bit later on in our presentation. So just hang tight. So, welcome to our presentation, How Tax Planning Changes Through 4 Stages of Retirement. My name is Eric Blake. I'm a certified financial planner. I am the founder and lead financial planner of Blake Wealth Management here in beautiful McKinney, Texas. That's about 30 minutes north of downtown Dallas if you are unfamiliar with this area. But we actually have clients all across the country, North Carolina, Arizona, Michigan, Maine, so all across the board. So also feel free to drop your location in the chat box. Would love to know where you're joining us from today. But as a firm, we support women that are approaching retirement to help you put the pieces of the retirement puzzle together in a way that provides clarity of your future and ensures dignity and independence throughout your retirement years. Now, whether you're single, divorced, widowed, or you may simply be ready to just take control of your financial future. So, of course, you might be asking, well, did he just say that they only work with women? And the answer is that we primarily work with women. We do work with some couples, but only if both spouses are involved in the planning process. And just to share a little bit about my background and why we would prioritize working with women, it's because I was raised by a single mother. And my grandfather, who was my father figure, passed away when my grandmother was only 62 years old. So I have seen the challenges that many women face especially when they're facing retirement on their own. Now, ultimately, I consider it to be really 3 keys to a successful retirement, especially for women who may be approaching retirement on their own. The first of these is going to be optimizing Social Security. Do not leave money on the table because you didn't understand your options. That may be maximizing your own benefit. That may be spousal or ex-spousal benefits, survivor benefits, whether it's your current spouse or an ex-spouse. That's huge. Number two, investing smarter. Statistics tell us that even if you are married now, you will most likely outlive your husband. We need an investment strategy that's going to ensure your money lasts as long as you need it to. And then lastly, and the topic of our presentation today, is minimizing lifetime tax liability. Bottom line here is that the less you pay in taxes, the more likely your money is to last. So I do thank you for joining me today to learn more about taxes in retirement. And I want to assure you of one simple thing about this presentation. I believe you're going to be better informed about the challenges of retirement tax planning after listening to this talk. You know, from time to time, I present workshops and classes on various financial education topics for women, such as Social Security, retirement planning, IRA planning, retirement income, healthcare planning, among others. And my goal is always to inform and educate my audience so you can understand how critical these retirement planning topics affect you. And I do this presentation, quite honestly, because I've seen many women who have made mistakes and pay more in taxes in retirement than is necessary. And when that happens, it does make my job just a little bit harder, simply because if you have less income in retirement, we may have to be a little more creative to make sure that your money does last as long as you need it to. And I know taxes can seem complex, jargon-filled, even though the underlying concepts can actually be fairly straightforward. And this presentation itself is going to be organized into 4 keys, each of these keys building on the previous one to form a solution to our presentation problem, as you're going to see. Now, I know that very likely you're going to have questions as we go along. I always want to be respectful of people's time, so I'm going to wait and take questions. I'm not going to take them during the presentation. I'm going to wait to make sure we get done, because I do want to try to be done in about an hour. I think that's for most people, that's about the extent of their ability to concentrate on taxes. So if we have the opportunity to address your questions at the end, I will do so. If we don't have an opportunity to get to your questions, I do receive all your questions by email and I will respond to you directly. Now, I also want to mention one more thing, that at the end of our presentation, I'll also invite you to engage in our Simply Retirement Roadmap process. This is our 2-meeting process designed to answer your most important retirement questions, primarily focused on optimizing Social Security, investing smarter, and again, as our presentation today focuses on, minimizing lifetime tax liability, those 3 keys that I've referenced a couple of times now. You're going to have the opportunity to review this process after we've wrapped up our presentation today, and it starts again with a simple 15-minute introductory phone call to answer your questions and determine if taking the next steps is going to make sense for you. I also want to assure that this is not a sales presentation. You will hear nothing remotely close to a sales pitch. My objective is that you are a much higher level of understanding, that you have a much higher level of understanding around how important tax planning is in retirement. Now, before we get too far, again, just have a few housekeeping items here. First, please glance through the disclosures on your screen. Just be aware that this presentation is for educational and informational purposes only. If you have specific questions, you may want to talk to your own financial advisor, your own tax advisor about those particular topics. Secondly, everyone's tax situation is different. You should always, again, contact or consult a qualified tax professional, tax advisor to discuss your specific tax situation, especially about some of these topics we're going to be talking about today. First, traditional IRAs, tax deferred. You must pay taxes on distributions or conversions at ordinary federal and state tax rates. Roth IRAs. This is money that grows tax-free, and earnings may be withdrawn tax-free in accordance with IRS rules. And lastly, state taxes. This presentation, we're going to focus primarily on federal taxes. You may, depending on where you're located, you may actually still also face state taxes. So again, you want to check with your tax professional. I'm a financial planner. I do not provide tax advice. What I do is help people understand how the tax code and other rules could impact your financial planning and your investments, and then we develop a plan to take into account many of the odd things that people encounter, especially around taxes in retirement. And our goal here is to help you understand that the retirement distribution game, Spending assets in retirement is much different than the accumulation game when you're saving for retirement. Chances are you've been in the accumulation phase of your life for several decades, and you've been working hard trying to save money, and hopefully your accounts have grown. But now, as you enter or prepare for retirement, you're in an entirely different phase, what we call the distribution phase. And the distribution phase has new, strange rules that can catch people off guard. And along with those new rules, there are often many changes in your own personal life that can have a big impact on your taxes as well. For instance, if your children are grown now, most likely, and that means no more child tax credits, or your house has been fully paid off, so no more mortgage interest deduction. Now, if you're already retired, you may no longer be receiving tax-free employer-paid medical insurance. If you've stopped working, you may no longer have the ability to stash income in a 401k plan or similar plan to manage your annual tax bill. Now, at some point, you'll start taking Social Security as well. Sooner or later, when you reach 73 or 75, depending on your year of birth, you'll have to start taking required distributions from your retirement accounts as well. And the list of changes goes on. Many aspects of retirement will affect your tax bill in ways totally different from your working years, and understanding what these are and how they can impact you is absolutely crucial. So that brings us to a simple statement about the problem we are here to discuss. Simply put, people often pay more taxes in retirement than expected because a confusing system treats various income types differently and contains hidden taxes and penalties. In the accumulation phase, people build their assets in different forms. It could be stocks, bonds, real estate, pensions, 401ks, IRAs, and Roth IRAs, and more. In the distribution phase, your regular wages are going to stop. They're going to stop coming in. You have to take the money you've saved and use it to fund your retirement, which could be decades with good health on your side. Now, that's challenging because you'll need to make informed decisions about the tax implications of tapping into different accounts, and that can be costly. In retirement, your tax rate can vary dramatically based on decisions that you make, such as the timing and the order in which you use different sources of money to pay for your expenses. And unfortunately, poor choices through misunderstanding or ignorance of the rules can result in people paying way more in taxes than is necessary. And as a result, you may see that your savings drops faster. And that can mean less to leave to kids and grandkids as well, if that's something that's important for you. Now, of course, we don't want that to be you. And the fact that you are here means that you are willing to work towards a solution, which is obviously the important first step. Because your tax exposure will change throughout the 4 stages of retirement, you'll need a strategy that anticipates both traditional taxes and possible taxes, surcharges, and penalties related to Social Security, Medicare, and other income sources. That means you'll need an informed and proactive plan that addresses how you create your income in retirement. Now, my goal is to introduce you to the major aspects of such a strategy and show you the challenges that we will face, and then explain what makes up a workable solution to our retirement tax problem. Now, the first step is to develop an understanding of what types of taxes that you may face. And what do I mean by taxes? I'm talking about all the costs that can increase as your income does, including some that aren't actually called a tax. To me, if your cost goes up as your income rises, that's a tax in my book. But you also need to understand that retirement expenses that you're going to face. And you'll need to create a strategy that will help you decide which of your assets to tap first, how much you should be taking from those assets, and when those distributions need to occur. Getting this right will help you pay as low a tax rate as possible. All right, so before we go on, here are our 4 stages. Let's talk about the 4 stages of retirement that we're going to be discussing in our presentation. Now, these are rough ranges and descriptions. Your experience may differ. This is just a framework for discussing our topic. So first we have what we call pre-retirement, the final work and save years, somewhere between around 50 to 60 years old. Then we have the early years of retirement, 60 to 70, what we might call the go-go years. People often have great plans, big plans for this time, like traveling or volunteering, starting new hobbies, working part-time, spending more time with family. But then you're going to reach the middle years of retirement. Say it's 70 to 80 years old, what you might call the go-slow years. which bring more financial decisions such as how to deal with the required distributions from your IRAs and other retirement accounts. And then eventually, we get to those later years of retirement where your health may not be as good and you're thinking about your legacy and your estate, the no-go years. That starts somewhere around the 80 plus. And as you're going to see, there is a wide range of issues that you must be planned for in each of these different phases. And this can be a lot harder than it seems because retirement is just full of surprises, and even the best planning will divert from reality at some point. Now, one future unknown is inflation. We've seen that in the last couple of years, what the volatility there can be, and people tend to view their future costs in current dollars, in today's dollars, and don't always anticipate how those costs will grow with inflation over time. So if you think back 30 years ago to the cost of a gallon of milk, or a gallon of gas, or a visit to the emergency room. Now think about those costs today, and they'll grow to what they'll grow to over the next 30 years when you're not working. That's inflation. Or how about your longevity? Many people end up living far longer than expected, and that requires more money at the time when it's difficult to work. How long do you think you're going to live? And many people underestimate how much money they need to maintain a pre-retirement standard of living. And who wants to have their standard of living drop in retirement? Ideally, we want to try to keep at least a similar or same lifestyle. And then, of course, we got healthcare costs. That's the 10,000-pound gorilla here. That includes your out-of-pocket payments for services and drugs, plus Medicare and insurance costs, which, again, keep rising. So at this point, you might be thinking, okay, so what's the first thing I need to understand about retirement and taxes? Well, here it is. Let's talk about our first key. You have to know your after-tax retirement savings picture and what it looks like before you actually retire. That's key one. Because a $500,000 401k or IRA balance isn't really $500,000. The government has a claim on part of that money because the taxes have been deferred to this point in many cases. They're going to get their share when you are forced to start your required distributions. The Secure Act 2.0 has pushed back RMDs to 73 or even 75 if you were born in 1960 or later. So RMDs are at 73 if you were born between 1951 and 1959. If you were born after that, you won't have to start RMDs until you turn 75. Now, obviously, the higher your tax rate in retirement, the less your account is really worth. So here's an example. This chart shows you the cumulative after-tax value of a $500,000 IRA earning about 6% per year at different tax rates. As you'll see, the lower your tax rate, the more you keep. Pretty simple in theory, but difficult in practice. And by the way, of course, this presentation applies to both pre-retirees and retirees, so don't worry if you've already started your retirement. Tax planning is just as important throughout your retirement years. Okay, so you may be thinking, okay, if my accounts may not be worth as much as I thought, but I have a steady flow of benefits from Social Security to supplement my income, and I'll have Medicare to pay for my healthcare costs. But here's the one thing you need to understand when creating a retirement tax strategy. Social Security and Medicare have their own tax traps that you need to plan for as well. That's key number 2. So let's talk about Social Security and taxes here and help you understand exactly what we're talking about. So let's go back to Sue from our tax brain teaser earlier before we started the presentation. We want to understand why she paid such a high tax rate on that extra money that she took from her IRA to go on that road trip with her granddaughter. So remember, Sue has $40,000 of IRA income, part of her adjusted gross income of that $65,538. And she has $37,500 of Social Security benefits. So that puts her pretty squarely in the 22% tax bracket, and she takes the standard deduction. Yet, when she took that extra $1,000 distribution, she got hit with a nearly 41% marginal tax rate, $407 on that $1,000. So let's break this down and see what actually happens. So the first thing is to remember, the only difference between our two scenarios here is that Sue took an additional $1,000 from an IRA, and you see that in the after concert trip column where she now has $41,000 in IRA income. So we see here that by adding that additional $1,000 of actual income, it increased both her AGI and her taxable income by $1,850. That means for every dollar of income she actually received, she's being taxed on $1.85. So how in the heck does this really work? All right, so here's the deal. Depending on how much other income you have, the amount of your Social Security benefits that are taxed varies. For instance, if your other income is low enough, all of your Social Security benefits will be income tax free at the federal level. Now, on the other hand, if your income is high enough, up to 85% of your Social Security benefits can be taxable at whatever your personal tax rate is. So what happens is Sue finds herself in that latter scenario. At her current income, after the concert trip, for every dollar that she takes out of her IRA, she not only adds $1 of IRA money to her taxable income, but she must also add an additional 85 cents of taxable Social Security benefits. And if you add that up, that's $1.85 taxable at her 22% tax rate for every $1 of additional IRA income that she actually receives. So if you do the math on that, it comes out to 40.7% real tax rate on that $1,000 in income. That is what we call the Social Security tax torpedo. It can impact single filers and married couples with pretty even just modest income levels during any stage of retirement. It's one of the reasons why planning taxes in retirement is so crucial. Let's look at another aspect of Social Security and taxation and how people approach retirement. So now during the go-go year stage, some people retire altogether, but other people, they may enter into some sort of maybe semi-retirement. Sometimes it's a continuation of the previous job, just taking on a few hours over per week. Others use semi-retirement to explore an interest in some new field. Still others may use semi-retirement to pursue a non-paid reward, some type of volunteer work. So working in retirement can impact your planning and taxes in a number of different ways. Some good, some bad, and some downright just ugly. So let's look at how working during these years can be a good thing. So chances are you've researched what your Social Security benefit might be at various ages, but you may not know that your Social Security benefit is calculated using your highest 35 years of inflation-adjusted earnings. Well, so what if you started working later in life? Or what if you left the workforce to raise children? You may not have 35 years of earnings history, and suppose you only have 28. So the remaining 7 years count as a big fat zero when calculating your benefits. But there's good news here. So earnings at any age can help you increase your Social Security benefit. And thanks to the Social Security how Social Security calculates benefits, replacing several years that have zero, even if it's just modest earnings, can positively impact your benefits. So let's look at how working during your go-go years can be somewhat bad if you're already collecting benefits and are unaware of the Social Security earnings limits that apply prior to reaching your full retirement age. So here's how these rules work. So if you start Social Security, be it on your own retirement benefit or a spousal benefit, prior to the year you reach your own full retirement age, for every $2 above a certain amount that you earn, it's for 2024, it's $22,320. Social Security benefits will withhold $1 in benefits. Now keep in mind, we're talking about earnings here, like a W-2 salary, hourly wages, salary, self-employment income, not pensions, interest dividends, or capital gains. They don't count, and that won't reduce your Social Security benefits. So for instance, let's say that you earn $24,320 in 2024. That's $2,000 over the limit. Therefore, under the $1 withheld for $2 earning rule, Social Security is going to withhold $1,000 of your 2024 benefits. Again, but this is something important. I always want to stress this. These benefits are not truly lost. When you turn full retirement age, your benefit will be adjusted to make it as if you had applied at full retirement age with respect to those withheld benefits. In other words, your benefit going forward will be a bit higher. And then also in the year that you reach full retirement age, there's a separate higher earnings limit. So that's important to be aware of as well. All right, so we've talked about the good and the bad. Now let's get to the ugly. We're here today to talk about taxes in retirement, but there are other taxes that you may face. For instance, while you're working, you're subject to a 7.65% Social Security and Medicare tax, in addition to your normal income tax. The self-employed individuals, they pay twice that amount, so 15.3% to cover both the employee and the employer's portion of your Social Security and Medicare. Now, these taxes don't go away if you're working past your full retirement age, or even if you're collecting Social Security. And what's worse, if your go-go year's earnings don't make it into your top 35, those Social Security taxes go into the trust fund and they do not increase your benefit. So again, you want to be aware of that. Again, it comes down to planning. If you're receiving Social Security and you're working, you got to know what the implications are. Okay, so let's talk about Medicare and taxes and things you need to be aware of here. Now let's take a look at how Medicare and something called 𝐅𝐸MA can impact some couples and individuals in those go-go years and beyond. So first, what's 𝐅𝐸MA? 𝐅𝐸MA stands for Income-Related Monthly Adjustment Amount. Now the emphasis here is on income because it is a monthly tiered surcharge, again, a kind of a tax that is tacked on to people's Medicare Parts B and D premiums. But it only happens if you have income over $103,000 for single filers and $206,000 for married couples filing a joint return. That's for 2024. So let's take a look at what this means in action. So again, we have Martha. She has a good income. She has both Medicare Part B and D. 𝐅𝐸MA surcharges affect income from 2 years prior, and she's going to be on track for 2024 to have $161,000 of modified adjusted gross income, or MAGI, here in 2024. But December 1st, 2024, she decides she's going to sell a stock she bought for $10,000 on July 1st, 2007. So she purchased the shares in 2007. She sold the stock for $11,000, resulting in a $1,000 gain taxed at 15% long-term capital gains rates. And that's, again, applicable to her situation. That's a total federal tax bill of 15%. So Martha owes $150 in tax on the gain on the sale of her stock, right? 15% of $1,000. Or does she? Now, again, remember, my definition of a tax is any cost that increases as your income increases. So then Martha will owe more than $150 because the gain of the sale of the stock pushed her over the Medicare 𝐅𝐸MA cliff into paying higher Medicare premiums. So let's take a look at why that's the case. Now let's look at this Part B 𝐅𝐸MA chart. So that extra $1,000 gain pushed her AGI into that next premium tier that starts at $161,001. So now, instead of owing $174.40 for her monthly Medicare Part B premiums, she's going to owe $279.50 per month. That's an extra $104.80 per month for an annual total of an additional income-related monthly adjusted Medicare Part B premiums of $1,257.60. But it's not over. So because Medicare Part D 𝐅𝐸MA charges are also impacted. So Martha's going to owe another $20.50 per month for her drug plan, an extra $246 over the course of a year. So adding up all the 𝐅𝐸MA surcharges together for the year, Martha is going to owe an extra $125.30 a month, or more than $1,500 of additional charges for the year. Now, so we combine that amount with the $150 of actual federal income tax she would owe on the stock sale, and the total tax owed on the $1,000 of gain comes out to $1,653.60. That's a tax rate of 165.4%. So let me repeat that. That is a tax rate of 165.4%. So let's do a quick review on this. So she sold the stock for $1,000 in income. That's the gain. The stock sale tax was $150, 15% of her which is her long-term capital gain rate. The extra income from the stock sale triggers new 𝐅𝐸 tiers. The total 𝐅𝐸 surcharge amounts to, for the year, to $1,503.60 for Martha in her case. So that $1,000 of extra income triggers $1,653.60, a 165.4% real tax rate. So you see that being pushed into a higher Medicare Part B and D premium, that rate, that increased rate, that's worse than being pushed into a higher tax bracket. That's because if you go over a regular tax bracket by even a single dollar, it's only those last dollars that are actually taxed at that higher rate. But if you go over the Medicare Part B and D income levels by even a single dollar, you move into that next premium tier. And it doesn't matter if you exceed it by $1, $1,000, $100,000. That's what they call the 𝐅𝐸 cliff. So keep in mind that your 𝐅𝐸 payments aren't determined by how much money you made the previous year, but rather from your 𝐏𝐥𝐸 from 2 years ago. It's another tax thing that catches people by surprise, and it really does need planning. So if you're eligible for Medicare in 2024, your premiums are going to be determined by your 2022 𝐏𝐥𝐸. Your 2023 is going to determine 2025, and so on. So again, you just want to be prepared for what these potential mousetraps might be. Now, of course, making sure that you enroll in Medicare at the right time is a critical decision as well. So if you bungle it, you'll get hit by a lifelong penalty. So to help you understand, let's talk about Jim and Ann. So both are 68. Jim retired at 65 and Ann retired at 66. Prior to her retirement, the couple had health insurance through Ann's employer. And they continued that after Ann retired because their employer offers retiree health benefits. Now, unfortunately, they didn't know that they had to enroll in Medicare Part B as soon as Ann retired. So even though Ann's employer offers retiree health insurance benefits, those benefits are generally paid secondary to Medicare after retirement. But Jim and Ann didn't realize the mistake until it was too late. And thanks to the way Medicare enrollment periods work, they weren't able to begin coverage until that next year. So a worst case scenario, this might have resulted in a gap of coverage for Jim and Ann if they had a major medical need. But even in a best case scenario, because Jim and Ann missed the deadline to sign up for Medicare Part B, they will each owe a 10% Medicare Part B base premium penalty for the rest of their life. So you can see how much that translates into real dollars. So they owe $420 extra in 2024. And then historically, we can estimate that premiums will be higher, so that 10% penalty will grow and grow. So over the course of a lifetime, that could translate into a $10,000 mistake for this couple. Now, for simplicity's sake, we're assuming that Ann's retiree health insurance covers prescription drugs, so they don't have to sign up for Part D, but just know there is also a penalty for that. Okay, so we've seen how Social Security and Medicare have their own tax traps and unique rules and penalties. So if you're like some who've seen this presentation, you're going to be asking yourself, well, wow, what other tax traps could I face in retirement? So the rest of what we're going to be covering isn't like what we've seen with Social Security and the tax torpedo or the Medicare 𝐅𝐸 cliff. The public generally isn't aware of those tax squeezes. So what we're going to be seeing now is how the tax code in plain view snags retirees, especially when there's no planning. And that brings us to our third key. You must plan how and when you'll use taxable, tax-deferred, and tax-free assets to manage your income and your tax brackets efficiently in retirement. You can't be haphazard about tapping into deferred savings, into your tax-deferred savings. Timing is everything, and if you don't plan carefully through all stages of retirement, you'll encounter some unintended tax consequences. So let's take a look by first addressing a question I hear often when doing retirement planning, and that is, which accounts should I spend first? So here's a common example. So here we have Mary. So she's been a good saver, as you can see, and looks forward to spending her retirement years traveling and seeing her grandkids. In addition to Social Security benefits, she has $450,000 in an IRA. She's got $60,000 in a Roth IRA. She's got $300,000 in a brokerage account, and she wants to spend about $8,500 per month, or just over $100,000 per year. So where would you take money from first? So most people will think, first take the after-tax money in the bank, and then take the tax-deferred IRA money, and then take the tax-free Roth money. Now, this is conventional wisdom. Now, it has been promoted by many big investment firms for some time now, and it's not a bad plan, but we know conventional wisdom isn't always the best approach. And not surprisingly, the topic has drawn a ton of attention from academic researchers specializing in financial planning, and they've conducted multiple studies on how to prepare for retirement using a combination of Social Security, taxable bank accounts, tax-deferred accounts like IRAs and pensions, and tax-exempt Roth accounts. And you can see some of the titles here of some of these different studies. And what the research has shown, that the conventional wisdom probably isn't ideal. So here is an alternative approach. So there are two key elements in the early years. First, use the taxable brokerage accounts for expenses, but also during this same period of time, accelerate IRA distributions during otherwise low income years, putting that money into your Roth accounts. Now, this is what we call filling your tax bracket. It's the filling your tax bracket approach, which we're going to discuss in just a little bit. But this is an alternative approach that gives you more flexibility to use those tax-free Roth assets strategically in those future years. Now, does it make a big difference? I really think it does. In the academic studies, this approach has been shown to increase portfolio longevity, and that is how long your portfolio assets will last without requiring you to take additional risk. Now, the big takeaway here, of course, is that you've got a plan. You got a plan all the way through retirement, especially around how you handle those tax-deferred assets. Now, of course, you want to, again, be sure you talk to your tax professional for any specific tax advice. Now, one way to help you manage your income both before and during retirement is to utilize Roth IRA conversions. Now, what a Roth IRA conversion is, it's a simple process that allows you to move money from an IRA or other pre-tax retirement accounts like a 401k or, again, traditional IRAs, SEP IRAs, 401ks, but moving those dollars into a Roth IRA. Now, in general, the amount that you convert is added to your income for the year, and it will be taxed at your current tax rate. But for example, if we have Jill, she converts $100,000 from her IRA to a Roth IRA. She will have to add $100,000 to her income. Now, that conversion income will be taxed at Jill's tax rate for the current year. Now, for that reason, it's recommended that prior to making any conversions, again, that you talk with your tax professional. Now, Roth conversion doesn't need to be all or nothing, though. A helpful conversion approach is something called we call it filling up the bracket. Now, often you may find yourself in the middle of one of the tax brackets with room to add more income without pushing yourself into a higher tax bracket. So, for example, in 2024, the 22% tax bracket for someone filing a single individual return goes from about $47,151 to about $100,525. So if you file an individual return and your taxable income is $55,000, that means you could add about $45,000 of income without going into that next bracket. Making a Roth IRA conversion like that could make some sense. If you plan to convert a large IRA, this approach is often more tax efficient in that rather than converting the full amount in one single year. Instead, you can make smaller Roth IRA conversions over a number of years, filling up your bracket each time. Now, this can help you reduce your average tax rate that you're going to pay on the converted money, and also spreads out that tax bill over a longer time period. Now, Roth IRA conversions can be really powerful in those years where your taxable income is going to be low. So it might be a year where you've got a significantly higher medical expense deduction, or maybe you have a low sales year if you're a business owner. Use those as opportunities to at least explore the ability to do a Roth conversion. And it's also common for people who retire early and are not yet receiving Social Security benefits or pensions or IRA distributions. Again, you may be in a very low tax bracket, making it a good time to complete a Roth conversion in those pre-RMD gap years. Okay, so this is a good time to spell out the crux of things. So you must know whether you're trying to keep your income below a certain bracket threshold to avoid bumping into that next highest tax rate, or whether you're trying to increase income to fill up a tax bracket to take advantage of that tax rate. Now, some tactics that you can use in managing income around tax brackets might include some of these, something like drawing tax-free money from life insurance policies to keep your income low. Maybe selling highly appreciated stock for low to no capital gains. You might also think about taking distributions from IRAs or 401ks to take advantage of a lower tax rate. And of course, as we've already seen, we spent some time on, you can also consider partial Roth conversions to fill up these lower tax brackets as well. There are also a couple other pre-retirement strategies that you might think about that don't necessarily apply to everybody. The first one has to do with how you use your health savings account. And this would only apply to people who are covered by a high deductible health plan. Now, the second has to do with small business owners. Those who want to be extra tax savvy and saving for retirement can fund a company pension plan, which for certain high business owners can also increase their ability to claim the qualified business income deduction, the QBI deduction. And both of these features of the tax code could be used to manage your tax exposure and provide significant tax favored benefits throughout retirement. If either or both of these apply to you, you may want to go and take a note down in the questions area if you're taking some notes, and then evaluate that and talk to your financial advisor, talk to your tax advisor as to whether either of those might be applicable to your situation. And we've seen throughout our presentation the critical importance of managing our tax deferred accounts, right? Because at some point, you'll be forced to take out required minimum distributions, or what are called RMDs. And that can be really troublesome on your tax bill. But also many people make charitable donations, supporting their favorite nonprofit with annual gifts. So let's take a look at how your RMDs and your charitable giving may actually be able to work together with some planning. So here we have Shirley, who is in the 24% tax bracket. Now, again, the standard deduction for individuals in 2024 is $14,600. But Shirley is actually over 65, so she gets an additional standard deduction, bringing her total standard deduction for 2024 to roughly $16,550. So this means that she's going to receive a no tax benefit for any itemized deduction unless it exceeds that $16,550 mark. So if Shirley has $10,000 of existing itemized deductions, let's say that's from maybe your state and local taxes, some deductible medical expenses, and some mortgage interest, what happens tax-wise if she donates $5,000 to charity? She gets no federal tax income benefit by making the charitable contribution because it doesn't exceed her $16,550 standard deduction. Again, that's not to say that she shouldn't do it, and that that understand that it's just not helping from a tax perspective. Now, if you are over 70 and a half and you have an IRA or even an inherited IRA, there's another way to give to charity, and it's as simple as writing a check. It's called a qualified charitable distribution, or QCD for short. So let me explain how it works so that you can see why a QCD can be so powerful. First of all, let's talk about the rules. So if you are 70 and a half or older, you can make a qualified charitable distribution of up to $105,000 from your IRA. If you're married and both of you are over 70 and a half, both of you have an IRA, you can each make up to $105,000 qualified charitable distribution from your IRA. And these are 2024 numbers. Second thing is that any qualified charitable distributions you make count towards satisfying your required minimum distribution for that year. However, when you make that distribution from your IRA, it must go directly from your IRA to a qualified charity. Or you can actually receive a check from your IRA custodian, but it must be made payable to the charity. Third thing is, and this is the odd part, that even though you give to a charity, you get no income tax deduction. So why would I suggest a strategy where you get no deduction for giving to a charity? Because when you make a qualified charitable distribution, that distribution from the IRA is never counted as income when you compute your taxes. So first, let's suppose Shirley, she does what most retirees would do, and she takes her required minimum distribution of $5,000 at the beginning of the year, and she deposits into her bank. She's done with her RMD for this year. Now, being a charitable person, she's donating $5,000 to charity. And now the end result is that the charity itself gets $5,000. Everybody understands that, right? So, but let's look more closely. By virtue of giving to the charity this way, Shirley's $5,000 charitable contribution will cost her a total of $6,200. Why? Because the $5,000 RMD that went into Shirley's checking account at the beginning of the year still has a tax cost. Remember, she's in the 24% tax bracket, so 24% times $5,000 equals $1,200. So the $1,200 of additional tax that Shirley must pay when filing her taxes means that the total cost of her charitable gift is $5,000 plus $1,200 or $6,200 total. Now remember, the gift didn't impact her standard deduction. So the RMD behind the gift just added to her income. So that can hurt pretty bad, right? Now let's see what happens if Shirley uses the QCD to give the $5,000 to charity. Instead of requesting a $5,000 distribution from her IRA to go to her bank account, Shirley would simply have her IRA custodian transfer the $5,000 directly from her IRA to the charity. So this satisfies Shirley's yearly RMD amount because she's over 73. Now the charity is in the same position as before. They receive a $5,000 donation. Have a good day. Shirley, however, is in a better position. She still gives $5,000 to charity. Even though she receives no deduction for making a contribution, her IRA distribution is going to be excluded from her tax return. Therefore, she owes no income tax on that $5,000 distribution. So her total to give the $5,000 to charity is $5,000. That's a savings of $1,200 over the previous example that I just walked you through, simply by knowing how to use the tax rules to her advantage. And again, she did this all without ever getting any type of tax deduction. Now, we all know that charity starts at home. We like to give money to charities, many of us do, but ultimately, we also want to make sure we leave a legacy for our family, for our children, our grandchildren. So the natural question to ask, of course, is how does retirement tax planning figure into this? How does it figure into my legacy, my estate plan? And that is a great question because the government still wants its share of those tax-deferred assets when you pass away. And like we've seen, how you go about setting things up really does matter, which leads us to our final key, number 4. Optimize or organize your assets for your family's benefit because estate planning really does matter from a tax perspective. Let's talk about that a little bit more. Now, maybe you're someone who has managed to save up quite a bit of money in your IRA or maybe your 401k, and you feel pretty confident that you're going to be comfortable in retirement, and you're hopeful that you'll be able to leave behind that account to your children or your grandchildren. Now, in the past, we'd have recommended that because of the right structure, your heir could withdraw money throughout his or her lifetime, possibly decades. But that has changed with the passage of Secure Act in December 2019. Now, beneficiaries of inherited retirement accounts, with just some exceptions, but in general, they must withdraw all the money within 10 years of the owner's death and pay taxes on those dollars. So this restriction of what used to be called a stretch IRA really does shine light on how important tax planning is because laws change at any time. So you need to have a plan. You need to be able to revisit that plan on a regular basis. So let's look at Pamela and Kyle as an example of what choices beneficiaries have when they inherit IRAs and no longer can stretch those distributions over their lifetime. So in our first scenario, we have Pamela and Kyle, her son. Pamela unfortunately passes away at 70 years of age, leaving the full IRA to her son, Kyle. Now, he's an only child, he is healthy, and he's the sole beneficiary of that IRA account. Now, we know that in Kyle's case, he has a maximum of 10 years to withdraw those IRA dollars to meet the required minimum distribution rules. Now, Kyle likes regular distributions, so he's going to choose to take equal distributions of the funds over the next 10 years. Let's say that IRA earns an average 6% rate of return on an annually. This payment would calculate to be about $54,347 to Kyle each year for 10 years. And again, Kyle would have to add this amount to his income on his tax return over those same 10 years. So again, understanding how that works is really important. Now let's look at our second scenario. It's a little bit different for Kyle. Let's say that Kyle, he's a little bit forgetful, not great with money, so he loses track of time. And he has already reached the year 10 of the required minimum distribution window. Since it's year 10, he must now take out the full distribution in one single year. So let's assume that same 6% rate of return is earned annually on the $400,000 IRA. We can calculate the IRA balance has grown to $716,339. And here's the worst part. Kyle must take the full $716,339 as a distribution in year 10 and pay the income tax on that amount. At that point, we probably have a pretty good idea that Kyle's going to be in the top tax bracket in year 10, taking a huge chunk and giving it right to Uncle Sam. All right, so let's talk. Let's get away from the death conversation. Let's talk about long-term care, another not so fun topic. And this is not a long-term care presentation. We very strongly believe you should have a long-term care strategy, whether that includes insurance or self-funded, whatever the case might be. Making sure that you have a strategy. But this presentation again is more about retirement and taxes. But believe it or not, there are actually a number of different tax breaks associated with long-term care insurance. So for example, long-term care premiums may actually be a deductible medical expense at the federal level, and you may even be eligible for some deductions or credits at the state tax level. So understand, if you've got long-term care insurance, is that going to be something you can benefit from? Then on the other side, of course, if you are receiving long-term care benefits, in many cases, those benefits are going to be tax-free. For instance, if you have benefits from a reimbursement style policy, those are going to be tax-free. In addition, if you have a cash benefit style policy, that can be tax-free as long as they don't exceed the higher of your actual long-term care cost, or there's an IRS daily limit, currently $410. So choosing how you actually pay for your long-term care costs can have a huge impact on not only your state, but also ultimately how much of those dollars actually go to your heirs. All right, so we're getting towards the end of our presentation, and you're probably thinking, goodness gracious, how in the world will I ever be able to manage this? And that's a good question, of course. So let's try to bring this all together for you. So we started with a clear statement about the problem. Retirees often pay more taxes than expected because a confusing system treats various income types differently. And as we saw, there was also a number of different hidden taxes and penalties within all these different retirement topics. So let's do a quick review on what we've learned in the context of the 4 stages of retirement. So under the pre-retirement heading, we saw that the importance of understanding the after-tax value of your retirement savings before you retire. And we also saw that in the previous pre-retirement years, in those pre-retirement years, it is critical to consider your tax-deferred savings and start taking advantage of funding your Roth accounts to fill your tax brackets, something you do through those earlier years of retirement in your lower tax years. Now, we also looked at Social Security and taxes, plus the importance of couples specifically having benefit strategy that considers a surviving spouse. Now, we saw Medicare also has its own tax-like structure that can push you over that IRMA cliff. And we saw the importance of signing up for Medicare on time, making sure you're staying in those proper windows right in the middle of those go-go years. That's because starting in your middle retirement years, you're going to be confronted with required distributions, and we've seen the importance of planning your income needs before then and the tax issues involved there. Then we saw the importance of setting up your assets and managing them during those later years of retirement so that you can preserve the most for your heirs and ultimately leave them with the most tax flexibility as well. All those items lead us to the obvious solution to our original problem. So because your tax exposure will change throughout retirement, you need a strategy that will anticipate how and when you're going to tap assets to cover your personal expenses. We need to understand the range of taxes that you're going to face at various stages of retirement, and we need to manage your actions so you pay the lowest tax rate possible. So if you're attending this presentation, it indicates that most likely you are preparing to leave that accumulation phase where you're saving for retirement and moving into that distribution phase when you start spending retirement assets. And of course, we've seen that the distribution phase is much more complicated than those working years when you're collecting a paycheck. Managing your tax rate through the 4 stages of retirement is part of the challenge of retirement planning, and we've seen what the potential costs of some of the mistakes that could be made are. So naturally, we want to be efficient with our savings, and there are strategies to reduce our tax burden, but as with many things in life, this takes education and planning and advice. And I know it's a lot to think about. Our tax code can be really complex, and the rules keep changing, worst of all. But what that doesn't change is the fact that you need a plan. So as I stated at the very beginning, we specialize in retirement planning for women over the age of 55. We want to help you develop a retirement strategy that provides dignity and independence throughout your retirement years. When you exit from the webinar today, you're going to be redirected to our website and our Simply Retirement Roadmap process. This is our 2-meeting process where we will help you answer your biggest retirement questions and also make an educated and informed decision about our firm. It starts with a very simple 15-minute introductory phone call to answer your questions and just determine if our expertise is a good fit for your situation. If so, we'll talk about what those next steps might look like. If not, we'll part as friends and we'll share some other resources that you might consider to help you along your retirement journey. Now, if you aren't quite ready to schedule that call, you can scan the barcode you see here to subscribe to our Simply Retirement podcast, where we address key retirement planning topics specifically for women, not only the financial topics, but some of the more emotional, non-financial topics that many women face along their retirement journey as well. So I'll give you just a second to scan that if you're interested. So as we wrap up, again, please remember that this presentation has been for educational and informational purposes only. If you have specific questions about your specific situation, you may want to talk to your financial advisor, your tax advisor. Unfortunately, again, we have run out of time. We are just right at that hour mark. However, as I mentioned, your questions have been emailed to me and I will respond to each of those questions individually. Thank you so much for joining me today. I hope you found this educational and helpful. Hopefully we'll have an opportunity to connect soon. But in the meantime, please remember that retirement is not the end of the road. It is the start of a new journey.